We're going to do chapter 3, adjusting accounts for financial statements. Okay, let's get started. Okay, now let's talk about the role of importance of periodic reporting and the role of accrual accounting. Our accounting period, remember, life of a company is divided into periods. A period can be different times. It could be quarterly, the 4 quarters in a year, each month, semi-annual, annually. And most companies will do their statements each month, each quarter, and each year. Now, remember, by law, if you're a publicly traded company, like the Walmarts or Targets, you have to release your statements each quarter and each year. In between, when a company first gets started, they got to decide what kind of accounting system you want to be based on. It could either be accrual-based accounting or cash-based accounting. The big difference is how do you recognize your revenues and expenses. Accrual accounting says revenues are recognized when they're earned. You've never received payment yet. Similar to expenses. It says you recognize expenses, record them when they've been incurred, even if you haven't paid them yet. Cash-based accounting says the exact opposite. You don't record any revenue or expenses until cash is exchanged. Now, most companies, let's see which one they're going to use more. 9 out of 10 companies and all the big companies, let's see which one they use more. Accrual accounting or cash-based accounting. It's going to be accrual accounting because the biggest thing is cash-based accounting violates GAAP. It's not GAAP friendly. Remember, GAAP's generally accepted accounting principles. Cash-based accounting is good for a company, for a small company, your mom and pop store. Maybe you don't even do any credit. You're cash only. That would be a cash-based accounting company. Let's see how accrual accounting works. It says, well, if you pay $2,400 for 24 months of insurance. Accrual accounting says because it covers 24 months, you're going to allocate that $100 per month, because that's how much it pertains for each period. So we see here, you start in 2017, $100, even though you paid $2,400, you allocate it over the life of the insurance. Cash-based account says you put it all in 2017, even though it covers 18 and most of 19. That's the big difference here. And these are principles of violation. Revenue recognition means you recognize revenue, you record it when it's earned, even if you haven't received payment yet. Okay, or the expense recognition principle. It says you record expenses in the time period they were incurred, such as, if you incurred the expense in May, you incurred it in May, even if you don't pay until June. Okay, we also look at adjusting entries here, the big thing here, adjusting entries. Now, adjustments are going to be a 3-step process here. First of all, they're going to pertain to 4 kinds of accounts: our prepaid expenses, our earned revenues, accrued expenses, and accrued revenues. First of all, we determine what the account's balance should equal. What the account balance should equal, and record just an entry. First, we're talking about is prepaid expenses or deferred expenses. They're paid for in advance, insurance, rent, supplies. Remember, a lot of these insurance, rent, supplies, either they expire over time, they get used up. Okay, various things can happen. If you pay insurance, he says you pay $2,400 to cover 24 months of insurance. Now remember, so we start off, prepaid insurance is an asset, it has a $2,400 balance. Now remember, even if you don't use insurance, it's expiring over time. We use it or don't use it, it's expiring. Every month it expires, it keeps going down. So we see here, we're going to allocate $100 a month because each month, for 24 months, it's going to be $100 per month it's going to go down by. It expires. And that's how much expense we want to put because that's how much insurance pertains to that period. Another reason why we should do it is because now, if you notice, you have the accurate balance for prepaid insurance. If I didn't have it, I wouldn't know how much insurance I have left. And I might not even have insurance. And again, the general entry. You always want to debit the expense, how much was incurred for that period, and credit prepaid insurance to decrease the prepaid balance. You want to update the balance to reflect how much insurance you actually have. And supplies, says you purchase supplies, $9,400. Now remember, supplies, think about your papers, your pens, pencils, paper clips. People use supplies over time for whatever reason. It says you started $9,020 and now you have $8,670. Because again here, your supplies, you got to update the balance to reflect what's your accurate balance of supplies. And you want to record for your expense how much supplies you've used up. Say, sorry, $9,720. And again, since we know we ended $8,670, the adjustment will be for the difference. we started at 9,000, now about down 8,670. So again, that's what you want to decrease supplies by. Because remember, supplies is an asset. It decreases with the credit. And you want debit supplies expense, because that's how much supplies you've actually used up for the period. And similar to what we did before. Remember, the accounts or the adjustment is going to be debit the expense and then credit supplies. So this reflects how much supplies we used for that period. And now I have the accurate balance supplies. If I didn't make the adjustment, I'm going to think I have $9,720, but in reality I have $8,670 in supplies. And depreciation is when you allocate the cost of an asset over its useful life. And again, this is for your equipment, your buildings, your cars, a lot of your various assets. Again, you want to use for now the straight line formula. Take your cost minus salvage value divided by useful life. A useful life of an asset is when you estimate how long do you think you can keep that asset for. Okay, such as when you buy a car. Someone will say, well, keep this car for 5 years, 6, 7, 10. You estimate it. You might get there, you might not. And useful life, how long do you think, it no longer satisfies a need? All the wear and tear. The salvage value says at the end of its useful life, how much do you think you can get for that asset or its value? I'll give you an example. Let's say I bought a brand new car. I paid $20,000 for that car. Okay, that's fine. I keep it for, we'll say, 8 years. Now, I take it back to the dealership. I'm not going to get $20,000. I say, well, I'll probably get about, we'll say, $4,000. That's the scrap value, residual value. And again, do the formula. This one says, okay, you bought an asset, $26,000. You estimate to keep it for 60 months, 5 years. You say your salvage value will be $8,000. So take the cost minus salvage value. It's $18,000. That's how much, remember. The net cost, that's what you depreciate. Not what you bought at, it's net cost. Cost minus salvage value. So again here, we take the $18,000 divided by 60. So again, we're going to allocate $300. We're going to depreciate that asset $300 a month. And again, when we do depreciation, we don't touch equipment. Never touch the original asset cost. We leave that alone. It's $26,000, we don't touch that. You want to debit the expense and create a new account called accumulated depreciation. Now, accumulated depreciation is a contra asset. It will take away from the equipment. And again, to do the entry, debit the expense, depreciation expense, and create accumulated depreciation. And we do that for the next 60 months. Now the balance sheet says, well, after 3 months, well, what happens? $300 a month, we see $900. So now the equipment's worth its net cost. The net is going to be $25,100. Yeah, take 26 minus the 9, the contra asset. And again, these are our various accounts we have for the prepaid. We have prepaid insurance, rent, supplies, depreciation. So we see it, just like we did earlier. Start at $5,000, should equal $1,000. And the difference is, that's what we record. Debit the expense, credit the asset. To decrease the asset and increase the expense, how much you've used up. Same with prepaid rent. Start at $12,000. Remember, prepaid rents, you pay your rent in advance. Now it's $9,000. Do the difference. Debit the expense, rent expense, credit prepaid. To update the balance to its accurate value. Now we do supplies. Start at $3,000, should be $500. Do the difference. $2,500. Now accumulated depreciation. Remember, follow the formula. $30,000 minus the $8,000 salvage value divided by 10 years. So again here, debit the expense, depreciation expense, create accumulated depreciation for $3,000. And unearned revenue is when you pay for, you receive cash in advance. So, such as, good example, say you want to buy an airline ticket, go to a concert, remember you buy that in advance. Remember, that company has a liability to you. They have to show you that concert or fly you to where your destination is. So here it says, paid a $60 fee in advance, covering the period from, okay. Now when you first receive, remember, this is not the adjustment. Remember, we never adjust cash. That's the one adjustment we never do. So again, you want to debit cash, increase your cash, and you want to credit your unearned revenue because now you have a liability. I owe $3,000 of services to this client. And we see here 5 days have passed. So 5 days, we've earned $250 of that $3,000 that we owe. So now we have to take the balance. it says, okay, now I owe $3,000, but I've earned $250 of it. Now I only owe $2,750 of it. I can put it down as revenue because I've actually earned it. Again, transfer it again. In this case, you want to debit the liability, decrease the liability, and credit the revenue to increase the revenue. Again, this goes for all of our unearned revenue accounts. So yeah, unearned revenue $24,000. Should be $16,000. In this case, remember, we got to debit the liability, decrease it, debit unearned revenue, and then credit revenue because that's how much revenue we actually earned. Same with this one, 600 should equal 400. The difference again, 200. Debit the unearned revenue and credit the revenue. Now, accrued expense means an expense happened in one period, but you're going to pay the next period. Such as it might have been incurred in May, you're going to pay it in June. But accounting says you want to put them in the period they actually happened. That way you know what actually happened in that period. It's accurate. If it happened in, if it's a May expense, it happened in May. It doesn't matter when you paid it. A good example is salaries. Since your employees make $70 per day, but the year ends Wednesday, so you got to put 3 days in December, the other 2 days in the new year. In this case, you want to debit the expense. Actually, both these accounts are being increased. You want to debit the expense because that happened in that period, and the payable because you owe your employees. So we see right here, it tells me I owe my employees $210. And of course the expense, that goes on the income statement. Both accounts are being increased. Now, it's not the adjustment entry. Now it says, well, why haven't you paid everybody? Again, my payable is gone now. It's all my books. It's okay, that payable that I owe is gone now. I want debit, decrease it. Expense now, that's for the other 7 days of the new year. Then cash for the total payment I paid all my employees. Again, example 1, should we talk about salary expense? Balance equals 0, should be $5,000. You want to debit the expense and credit the payable. In this case, it says your mortgage. It says, well, it was incurred in December, but you're not going to pay until January 3rd, the new year. That's 2 different time periods. So you want debit interest expense for $1,000. Of course, you want credit interest payable. So in this case, you want debit the expenses, credit the payables. They're both being increased. Accrued revenue means you earn the revenue in one period, be paid the next period. That happens a lot. It means you did jobs on credit. Remember, we do a lot. Remember, in accounting, a lot of jobs are done on credit. That's why it's very important. Make sure you keep them. Such as you might have done the job in May, but you might not get paid until June. So you always want to debit the asset, credit the revenue. So it says here, okay, you get paid $200, $20 service. Again here, we're going to do this one. You want to debit the asset and credit the revenue. They're both being increased. So we see right here, accounts receivable. It's an asset. It's going up. I expect to receive this $1,800. And I can actually put down revenue because even though I didn't get paid for the revenue, that's fine. Okay, I didn't, but except since I earned it, I can record it. That's the most important thing. Since it's been earned. That's the revenue recognition principle. That's right here, as we see right here. Accounts receivable, and of course, at the part 2, consulting revenue. And now again, now it says future receipt. This is not the adjustment entry. It says, okay, now you got paid for it. So it says, all right, so you paid for it. So again, obviously you want to debit cash to increase cash. You want to credit the receivable because now it's off your books. And then consultant revenue, since you earned revenue in this new period, you want to obviously credit that to increase it. An example of sum, so we talked about, the balance should equal 30. So, it starts at 0, it should be 1,000. And you also want to debit the receivable and credit the revenue because you've actually earned that revenue. In this case, remember before you owed interest. Sometimes now you get to receive interest. Again, debit the receivable, credit the revenue. And links to everything. Remember, it's very important. Adjustment entries, it's required. It's not optional. We can't omit it one period. No, they're required every period. That's why it's very important to do your adjustments and do them accurately. If you don't do it, the problem is your account's going to be off. Then you're going to make some, obviously, bad decisions on this. Now it says, after we do all of our adjustments, we complete what's called a adjusted trial balance. Now just a trial balance is okay, this includes your adjustments. So we start with just we did last class. Start with honest trial balance. Add our adjustments, from our receivable, supplies, and so on. And just a trial balance, that's what we're going to use to do our statements. Again, for your financial statements. And just we did our class. You always do minorities, start your income statement, revenue expenses, retained earnings and dividends, your balance sheet, your statement of cash flows. So we see how they all line in together. So we start off here with the trial balance. Okay, just like we did earlier. I always want to start in order. Bring them all down. And we do in order because we see here, start the income statement, net income. We need that for our statement of retained earnings. Now we have our retained earnings. We need that for our equity in the balance sheet. And remember, your assets always have to equal liabilities plus equity. If they don't, it's either a fraud or an error. Now, after we did all of our statements, everything was fun, we released everything, now it's time to do what's called closing entries. And closing process, we said everything, our revenue, expense, and dividends all brought it to zero. Because remember, these accounts, they're only for the one period. But nope, it's only good for one period, that's it. And if I don't close my revenue, I can't compare my revenues to, let's say, May and June. And close it out to income summary. Remember, income summary, it's a temporary account. It's only used during the closing process. Again, these are temporary accounts. Your permanent accounts, your assets, liabilities, retained stock, we don't close it out. Because remember, those pertain to more than one period. And again, we close out our balance of revenue to income summary. Debt balance expense income summary. Then remember, we got to close out income summary. It goes to retained earnings. Then dividends to retained earnings. Okay, so we see this. And after we close out all of our entries, we do what's called a post-closing trial balance. Remember, post-closing trial balance, it's only the permanent accounts and their balances. And these accounts are brought to the next period. And they're used for the next period going forward. So we see here, we have all our accounts, debits, and credits. And again, this is what's brought now to the next period. Now we do the whole steps here. Transactions, journal entries. So we see here, Magic Company. Again, so we did earlier. Start off, do all our financial statements. Now it's time to do our closing entries. You always want to start with your revenues. Now remember, we want to decrease revenues. Because you want to decrease revenues, we're not going to credit. You want to do the opposite. You want to debit it. Debits will decrease it. And you want to credit to income summary. That's what we close it to. Then you want to do your expenses. Your expenses, we debit to increase them. But now we don't want to increase. We want to do the opposite. You want to credit them to decrease them. The balance becomes zero. And the total goes to income summary. And the difference, 79,000 minus 64,000. Remember, income summary cannot have a balance. It's supposed to be closed. Then you put the difference, which is the net income. You close that out. You want debit income summary to close out income summary. It goes to retained earnings. And the last part, dividend. Dividends have a debit balance. Increase with a debit. So you want to do the opposite again. You want to credit dividends and debit retained earnings. Okay, then we see our balance sheet. Okay, the last talk about the classified balance sheet. And classified balance sheet is still a balance sheet, but in the meantime, we group similar assets and liabilities together. There's our current assets. What do we expect to sell or use within a year of the operating cycle? Here's our most liquid assets, our cash, our receivables. Long-term investments means, like the name says, you made a long-term investment over a year. It means I bought something, I'm not using it, some stocks and bonds. I plan to hold them for many years. Plant assets is your land, your building, your equipment. These are the objects we use to sell products and services. Intangible assets. These lack physical substance, except sometimes some companies, these are our most valuable assets. It's your patents, your copyrights. Current liability, what you expect to pay within a year or less. Your accounts payable, your unearned revenue. Long-term liability will be over a year with the operating cycle, such as your mortgage payable. An equity note, someone's going to the assets. So So we see here classified balance sheets. Again, so it doesn't change the balances. The only thing is how we group them. And you're not going to have every category, such as current assets. We know cash is a current asset. Accounts receivable. Planned asset is land. And current liability, accounts payable. Long-term liability, long-term notes payable. Accountant stock. And we see right here. All right, class, everyone's doing well. Let me know if you have any questions, okay? Thank you. Bye.